Welcome, everyone. I'm Angelo Robles. I'm the founder of Family Office Association and the host of the Angelo Robles podcast. It features Jim Murchie, co-founder of Energy Income Partners, known as EIP. And I would like to give a little bit of a shout out before we begin. I'd like to very much thank our great friends at Accordia Group, our newest partner, sponsor, and collaborator, who really helped make the introduction to Jim and put this, what I know is going to be a great conversation, together. We took the theme for today's discussion with Jim about profiting from the planned and unintended consequences of decarbonization from their innovative work with the Ruby ESG and carbon credit portfolio platform. And that is noted on our collaborative post on our Family Office Association website under Accordia as Decarbonization Blind Spot. How does your portfolio invest in companies that provide exposure to both voluntary and compliance carbon markets that bring capital to projects to accelerate global initiatives to reduce emissions of greenhouse gases?
So let me just back up and talk a little about what we invest in. And we invest in essentially legal and natural monopolies operating what we call poles and wires and pipes and tanks. I have been in the energy business my entire career. I started with the old Standard Oil Company of Ohio in 1982. It was majority owned by BP, and then they bought out the minority while I was there. From there, 1990, I went to Sanford Bernstein. I was the energy analyst there on the sell side for 5 years. My clients, a bunch of my bigger clients tried to hire me. I went to go work for Julian Robertson at Tiger for a couple of years, and then ran a long short hedge fund for 5 years, and then started EIP up because we got reverse inquiries, because I had been investing in these pipeline and wires companies from the mid 90s when I was at Tiger. And after the internet bubble burst, people were like, I'm kind of interested in real assets, hard assets. I kind of got burned in the vaporware of the internet bubble. Would you think about taking in outside money? That's how we got started. And really all I was trying to do was old-fashioned utility investing, because here's how it works. They're cost plus businesses. Their revenues are the sum total of all of their costs, including interest on debt, plus generally today about a 10% return on shareholder equity. And that number used to be higher with higher interest rates, about 13 or 14. Now it's around 10 for state regulated utilities. It's between 10 and 13 for federal regulated utilities. And so our whole approach is to own companies that have stable and growing earnings that support stable and growing dividends, because at the end of the day, your total return is yield and capital appreciation.
The task force on scaling voluntary carbon markets estimates that the demand in the voluntary market for carbon credits could increase by a factor of 15 or more by 2030, and by a factor of up to 100 by 2050.
Yeah, there are a lot of companies, as you know, whether Google, Facebook, Walmart, they all have clean energy initiatives. Google will be sort of net zero carbon in a few years. It is their belief that their customers expect this of them. Google has the scale and ability to actually, in effect, sponsor wind and solar farms. Their actions will actually get those projects built because of their scale. In the world of impact investing, that's known as additionality. Their actions are actually adding to the clean assets that are out there. They're having that impact. Smaller companies don't have that ability. So what they're left with is buying clean energy credits from someone who does have the scale to actually put in, say, zero carbon electricity. That then creates a market that others can tap into. And so what will be interesting to see as it evolves is whether these credits will be cross-border. So for example, will you have a clearing price of carbon because of all these voluntary efforts that they gets towards $100 per ton of carbon? And now you have a non-regulated power generator. He's not getting an allowed rate of return. He's a merchant power generator. And he says, you know what? I can do carbon capture and storage off of my coal plant or my natural gas power plant, and I can do that for $75 a ton. And if I can get 100 by selling those credits to a smaller company, doesn't have Google scale. There is, for example, a company, it's privately held by a company by the name of 8 Rivers. It's run by a guy named Bill Brown. They have one of their portfolio companies is called Net Power, and they have a 50 megawatt pilot test going on in La Porte, Texas. I have seen this. This is a gas turbine that burns pure oxygen. So its effluent is pure water and carbon dioxide, which it then uses under pressure to make the turbine run more efficiently. But you have a pure carbon dioxide exhaust that you can either use in an industrial process or stick back down in the ground where it came from. And their technology is penciling out at a number below the current price of wholesale electricity. In other words, you don't need subsidies to make this thing profitable. And so does that make natural gas a bridge fuel, or does it make it a dispatchable, reliable, resilient, safe, zero carbon source of electricity? When you start thinking about actually getting rid of the carbon, you have to think gigatons. You have to think the existing system, the existing infrastructure. And a lot of what's going to get us to zero carbon is running the existing system and capturing that carbon and sticking it back down on the ground. And I would say we should only be doing that if that is in fact the cheapest, most reliable source. I think all of these things have to compete on their merits. But the merits are, are you zero carbon? Are you zero methane? Are you safe? Or are you reliable? If you're a gas utility in the Midwest, what are you doing to make sure that the people that supply your gas have a clean chain of supply all the way from the wellhead? And so we now have a growing movement in the US called RSG, responsibly sourced gas. Blockchain technology will probably play a role where you could actually tag every molecule of methane when it comes out of the ground and trace it all the way through to its end use to make sure that molecule of methane has gone through a gas producer that is somehow certified with zero or very low emissions, and a pipeline system and a processing system that does the same thing. People are demanding that of fossil fuels because they're kind of under the magnifying glass. I listened to a panel. This was associated with the Aspen Institute, where we participate every year. They have a couple of energy environmental roundtables, and they had as a panel the Democratic senior analyst and the Republican senior analyst on the Congressional Committee on the Climate Crisis. So there is this committee, and what was interesting is these two people, they said they agreed on about 80% of what they worked on. And with the Republican person, it was interesting to see the statistics this guy was carrying around in his head. And he said, the amount of greenhouse gases emitted from a US LNG operation is half of the environmental footprint of what the Russians are producing and delivering to Western Europe by pipeline. So I haven't run the numbers, I haven't seen it, but I wouldn't be surprised if what he's saying is true, because we operate under stricter environmental regulations here than they do in Russia, the old Soviet Union. And so here already is someone on the Republican side of the aisle saying, look, I am for clean energy if it means everyone's breathing cleaner air, if it's something that what the Americans are already doing gives us an international competitive advantage. It's a national security issue, it's a jobs issue, it's a balance of payments issue, and it's a sort of international strategic issue.
How do you determine which parts of the value chain each participant should take responsibly in terms of upstream and downstream via emissions or emissions associated with a particular energy company?
So a society that depends on voluntary stuff is going to get just that. As James Madison said, if men were angels, we wouldn't need laws. So we have laws and we have regulations to collectively sort of enforce what the democratic process has collectively decided on. And there are always folks like Google and Facebook who voluntarily do this, and they actually sort of help pave the way for things to come behind them. But scale only happens when society as a whole decides they're going to do this and puts it into a regulation. And I think what I have learned over the years is that cap and trade and market systems work. I don't think there's much debate about that, so long as the market is designed properly and it doesn't sacrifice one element of the product, a performance element, in response to another, maybe say price. But standards also work. And so I would point people to the 2007 Energy Security and Energy Independence and Security Act came out of the Bush 43 administration. This was the legislation that got you LED light bulbs. They did not mandate LED light bulbs. They mandated a 25% increase in the efficiency.
How do you establish a transparent system for verifying claimed carbon reductions, including potentially the use of accredited third-party auditors when choosing investments?
Yeah, so I don't know the answer to that question. It is so far kind of down the road. But if you think about who we're investing in, the regulated utilities, any cost associated with that is something that they're allowed to pass on along in their rates. If you're a merchant company, if you're Exxon or Chevron or whatever, you always have to justify whether or not the money you spend on that kind of verification of the supply chain upstream of the raw materials you acquire and downstream of the people you sell it to is always something you have to justify to your board of directors is worth the payoff. And that's one of the things I try to remind people of, whether I'm talking to policy people or regulatory people or investors, that the unique position these regulated monopolies afford is that they have essentially unlimited private capital to fund businesses that are in effect public-private partnerships that earn that allowed rate of return only by sort of adhering to the requirements of their respective legislative authorities as exercised by their regulators, whether it's the federal or state level. So sitting at the center of the energy system is these regulated power utilities that can have an enormous effect outside of their own footprint. And there's already evidence of that, because the vast majority of the wind and the solar that's been developed in this country is sold under 20 and 25-year contracts to state regulated utilities, to cooperative utilities and municipal utilities that all have this cost plus model. They have the ability by law to pass along all those costs to their customers. And by having that 25-year contract, they lower by more than half the cost of financing those projects, both on the equity and the debt side. And so there's a lot of wind and solar you wouldn't have if the buyer didn't have the balance sheet and the legislative ability to write that 20 to 25-year contract. That shows you the power that these companies have in affecting change upstream of their operations and upstream of their footprint.
Electric vehicle mandates are rising towards 40% share by 2030.
Mm-hmm.
David, one of our live participants, sent in this question. Can the US grid meet the additional demand? And does it give the regulated utilities above trend earnings per share?
It helps on the cost absorption for the electric utility. So I'm going to answer that question first. Remember, they're cost plus businesses. And so the actual demand doesn't matter. Remember, so their profit is essentially, call it 10% times their book equity, or their regulatory book equity. And so whether demand is growing 1 or 2% or shrinking 1 or 2%, they still get their allowed rate of return. Remember, they're getting that in return. They're getting limits, if you will, on their profitability in return for having been granted a monopoly. Can the U.S. grid, build it? Absolutely. I really don't see the impediments from a capital standpoint of doing that. The only impediments are transmission, where you're going across somebody's property and crossing states.
How does blue and green hydrogen play into this?
So the way I think people should think about hydrogen is energy storage, not an energy source. And the reason is because you can't mine hydrogen. It's always linked to another atom, like, I don't know, water. And so it takes energy to separate them. And so the energy you put in is actually going to be more than the energy you take out. And so the reason you do it is because A, you need hydrogen for an industrial process, or B, you need hydrogen as a storage device because it is cheaper, say, than a battery. And, and this is where you sort of get into the economics of batteries, which is one of the more misunderstood parts of the evolving energy system. If you're running solar panels, and you're charging a battery every day and discharging that battery later in the evening when the sun goes down and people get home and turn on their appliances, that battery is being cycled 365 days a year and has a very low competitive cost. Solar plus batteries is competitive relative to the wholesale price of electricity, which is a competitive market. Mm-hmm. It's seasonal storage that is not even close to being economic, and probably for batteries, for lithium-ion batteries, never will, meaning that there will always be something cheaper. Hydrogen is cheaper than lithium-ion batteries. So if you think about it, if that windmill is spinning at night when no one needs the electricity, why not just let that windmill separate hydrogen from oxygen? And that is a cheaper way to store energy than building an entire battery of lithium-ion batteries, et cetera, et cetera. And so that's how people should think about hydrogen, recognizing that the existing infrastructure likes to use gaseous and liquid fuels that combust to drive turbines. And so remember, if you can use the existing infrastructure, you have saved yourself a lot of money, but by separating hydrogen from oxygen, you're spending a lot of money. So that's again why you should be mandating outcomes, not solutions, and let the really smart people out there come up with the cheapest way of achieving it.
Some of the work that I do with families is assessing their internal sovereign risk and helping them to mitigate that, often by becoming to some degree more global. I have grave concerns. I hope you could tell me they're overblown, but they're probably not. Here in the US, relative to the infrastructure and capability of our electrical grid. If I was a bad nation state, looking at cyber attacking and other attacks to our grid, I think is a grave concern.
If the grid is one giant interconnected system, you can bring the whole thing down. And the more dispersed it is, the better off we are. And we're going more dispersed, not because of national security, but because technology is allowing us to pick up cheaper, more distributed sources of energy, because we have the technology and because we have the data capability to handle all the information that it takes to run a bidirectional system rather than a dumb, over-engineered, steel-heavy radial system. But so far, there had been very little in the way of mandates to make our power grid more resilient to that kind of attack. We talk about it a lot, but again, investing in all these state-regulated utilities, there really isn't much happening in terms of dollars.
I believe you invest in regulated utility companies running pipelines and electrical power assets. How do these companies grow when demand for growth, if my research is right, which means it's probably not, is less than 1%?
No, that's dead on right. That's the biggest confusion that people have when they don't understand sort of the utility space. Now, if you look at the average growth of the Philadelphia Utility Index, it's only 3, 4, 5% over the last 20 years. But that's the average, right? And inside that average are non-utility businesses that have been shrinking for the last 15 years, merchant energy businesses, energy trading that lost money, all kinds of things, because after we deregulated electric power generation in this country, a bunch of the utilities had half of their assets in a cyclical declining merchant business and the other half in poles and wires. The average investor has no idea which those companies are. But if you could just invest in the regulated part of the pipeline companies and the power companies, which is how we construct the portfolio, and their capital growth plans, you can get above average growth. And you say, but they're still stuck with the 1% electricity, and I don't understand how they can grow 7%. And the answer is that they're laying capital down on the ground to access cheaper sources of energy.
Conventional energy stocks have started to outperform technology stocks. Why?
So we did a blog on this actually just late last week. So if you just go to our website, eipinvestments.com, we said it was FANG versus FANG, right? And so there's actually an oil producer called Diamondback Energy whose ticker is FANG, and so we just thought it would get people's attention. And so the byline I put on my LinkedIn page was how do oil companies in a non-growth industry, outperform growth stocks by trying not to grow. I mean, what you have to love, you go to an energy conference, it's 3 days. The person who speaks first is the energy economist, right? And he gives you all this data and everything. And the conclusion is what you said before. Energy demand is going to grow about 1% a year, even though world GDP is going to grow 3% a year, right? Then for the next 3 days, every energy company gets up and tells you they're going to grow their production somewhere between 3 and 5%. Okay, somebody's wrong. Either someone's not going to grow 3 to 5%, or they're not going to get a return on capital, or that energy economist is wrong with his 1%. And so, this is the issue you face when you're an oil investor. The only time to buy these companies is when they're in a bunker mentality. They're afraid to put the money back in the ground, as they should be, because they're technically brilliant. What these guys have accomplished downhole, just go to an offshore oil platform. I mean, it's a technological marvel. But don't ask these guys to allocate capital from your life savings. That's not their core skill set. They're engineers. And so if you give them the money with bad corporate governance, you're not going to get it back. They put $1 in the ground and 50 cents comes back out.